Jigar Mistry, the co-founder of Buoyant Capital, is now with us to talk about the market fundamentals. Jigar, it's good to see you in the last day of 2021. We're looking forward to getting interesting stock ideas as well as market insight about the way forward in 2022 as well. But first up, that correction which took place from November as well as in the first half of December seems to have ended for now, and markets have been consolidating for the last couple of days around that 17,000 mark. What, according to you, is the way from here on? At least as the earnings season kick in as well as the budget, how do you think the markets will behave?
Good morning, Rima. Thank you for inviting me again. So, if I have to summarize 2021 from a cricket lover's analogy, I'll start off by saying that we registered the win at the Gabba, which is considered to be Australia's fortress, in January. And yesterday we breached the Centurion, which is widely considered South Africa's fortress, right? So from a cricketing test perspective, it has been India's year. And if you look at the markets, it's pretty much similar. So other than S&P 500, which is the best performing index on a 1 year basis, we are a very close second, right? And, while all this is happening, it might behoove us to, note the fact that this is going to be the 6th year in the running when the markets are going to end on a positive territory. 6th year in the running. Before this, there has never been a 7th year running, right? So, nobody likes a party pooper on the 31st of December, but it behooves us to keep that at the background that there has never been a 7th year in the history of the Indian markets. Now, when you juxtapose that to where the Indian economy is going, the last time when the taper tantrum happened in 2013, India was widely considered as the fragile five. Right, today, India's software exports are higher than the gross oil imports, right? Gross being the operative word. So currency-wise, we are okay. Bank liquidity is today almost as high as it has been around demon levels, at the peak of demon levels. So liquidity is not going to be a problem. Economy, if you speak in terms of high frequency data, GST collection, the several managements we keep talking to, it looks like we are arguably looking at almost the strongest economy in a decade. So the conundrum for the investors is going to be, one, how do you evaluate the fact that economy will improve in the CY22 versus the high valuations and the super performance that you've already seen versus, the history is almost against us for a consecutively 7th best year in the running.
A lot of data points that you put out, Jigar, and most notably that we haven't gained for 7 years consecutively. But I will hold on to the cricket part that you spoke about because of the way the sentiment has been yesterday. A great game that we saw and great year for Indian cricket as well. But, at the same time, there are some risks. So to take that analogy of yours forward as well, we did see great performance at the Gabba, etc. The English series is still not over. We're leading, but we still have 1 match to go. And secondly, even the South African series, we have played the first match. There are 2 more matches to go. Yes, things look good, but there is that risk of the unknown. And over the last couple of weeks, we have heard the risk of the unknown play out. There has been a 3rd wave. And secondly, the global central banks, they are talking about tightening liquidity as well. So does that put some green on the pitch if you must?
Absolutely, Mangalam. So you are right. You have to keep leaving the balls that are outside, your strength areas. We should not really be looking to double down on multi-baggers in CY22. The way we are sort of approaching this is that, the ideal sort of way to work around this is to look at the capital protection, look at the, ideas where you can derive 15-20% returns, and that is where the bulk of the returns for CY22 are going to be. Yes, there will be, a few stocks and a few ideas that will be on its own, that will find its niche and keep going up. But other than that, the whole investor sentiment until 18th of October had been that, look, things only go better and, the stocks just do go up and you buy the dip. Right? That got severely breached in the run-up through November. And, I was talking on your show I think a few days back when we said that there could be a Santa rally, but that Santa rally essentially is going to be the one which is going to test your patience, and the fact that you should look at reducing the risks in your portfolio, the stocks that you were always wanting to get out of, given better pricing, etc., are the ones you sort of get out of. And then you get into the stocks that, if they correct 15, 20, 25% during the year, you would feel like adding on to the names rather than, selling those names. So our entire portfolio construct essentially has been to sort of get positioned in those names where you'd be happier buying 15, 20% lower rather than, thinking about the thesis at which point in time the market is entirely against you. So that's how I think at least we are approaching the whole construct.
All right. Hi, Jigar. Good morning and thanks for joining us. This is Pavitra. Season's greetings to you. You were mentioning that this is a good time to sort of get into stocks which maybe were a little bit more expensive and now have corrected probably at more comfortable levels. Now, take us through some of those picks. I know you like the banking names, so take us through what you like within the banking names and any other sectors that you would look at these levels.
Yes, good morning, Pavitra. Season greetings to you too. Yeah, banking is very interesting because we keep mentioning that there is one which is fundamentals, the other part is liquidity. And while the indices have benefited from the liquidity infused by the central banks, the FI selling that has been the highest, I think, in the last 3 months has seen the banking names correct a lot more than you would have ideally seen, given what valuations and the commentary that was presented to us at the end of second quarter. And therefore, we at least are looking at this in a way to get positioned in the banking names even stronger than what we had done. The third wave, in terms of, we are still yet to see how that sort of transpires into the healthy and the health circles. But as far as it relates to, the health emergency translating into financial emergency, wave 2 was already weaker than wave 1. And wave 3, we think if at all that comes, will be, weaker than wave 2 as well. And therefore, banking names are ones, one should get positioned in that. The ones that we own and like the most are the likes of ICICI, SBI, Federal, Axis Bank, the likes of those. The other place which is very interesting is select commodity names, the chemicals names, where, they're corrected a little bit. They're now starting to sort of come back a little bit more. But the ones that we own in this space are Gujarat Fluorochemicals and Sudarshan Chemicals. For us, those names still offer, the fluorochemistry at least offers a lot of upsides in our opinion. SRF and Navin Fluorine are the ones that have been going up a lot. Gujarat Fluorochem hasn't really followed that much. So that is relatively interesting. And the third space, I think, which investors will start taking cognizance of very soon is the technology pack. Now, most of these tech names have corrected since the results that they reported in the second quarter. Most of them have corrected, and although your IT index doesn't really show that has really happened, but if you look at TCS, you look at HCL Tech, from the last quarter numbers, they have been down big time. The one that we like in this space, again, valuations for the larger caps are a little bit richer. But Cyient is one company that we have owned for a while here. It's a global ER&D play. It does a lot of work for the likes of Boeing and engine off engine work. But it's available at 20 times. It might as well sort of double down as a reopening theme. And given where the rest of the peers are for Cyient, this is a very interesting play for us.
Very, very quickly, Jigar, because we're out of time. What about the unlocked themes like hotels, restaurants, cinema exhibitors like PVR? Yesterday, we had one guest tell us that you should buy good companies in bad times. We've seen these stocks correct as the restrictions have picked up in India with COVID cases rising. But so is that a space, given the recent correction, one could look at buying any of these?
The ones that you mentioned, Rima, are not really the ones that we are positioned in. We think disruption needs to play out enough for us to be, very interested in this. Good stocks, bad times is a decent play if they are available at a reasonable valuation. If you look at the charts that you're showing on your channel, they're not really prices that one likes to get positioned into. The ones that we own in this space are ones, we have discussed in the past. We had a lot of exposure in these name spirits, a few hotels, etc. But the ones that we have in our portfolio are three. One, Aditya Birla Fashion. Second is Pokarna, and third is Rupa. They are not, very strictly just reopening place, but these are companies whose valuations have corrected, and now, they do make for an interesting bit when the markets open up.
I take your point, because not strictly reopening plays Rupa for sure, because whether it's closed or open, you do consume their products. Thanks a lot, Jigar, for joining in and giving us all those details. We wish you a good 2022, wish you and your team from our side as well.